Awesome. Well, looks like we're ready to get started. So, hi everyone. Super excited to be hosting our Fall 2025 Demo Day webinar. My name is Sarah, and I'm on the venture team here at AngelList. So, today during our webinar, we'll start with a quick overview of what AngelList Demo Day funds are, and then we'll get into some of the questions that were sent in from our fund leads. So, before we get started, I wanted to go over two housekeeping items. So first, we will be recording this webinar and we'll share it with all of you tomorrow through email. And we'll also be uploading the recording to our AngelList YouTube channel. And second, we'll be spending some time going through some Q&As with the Fall 2025 Demo Day Fund leads. So we had a lot of questions submitted in advance, but please feel free to drop any additional questions in the Q&A function on your Zoom bar. So towards the end of the webinar, we'll try to get to as many questions as we can. Awesome. Well, thank you again, everyone, for joining and showing interest in learning more about our funds for the YC Fall 2025 Demo Day batch. And for those of you who are new to AngelList, we focus on building modern software and pairing that with premium services to help firms ranging from both emerging managers to more established firms launch new investment vehicles or streamline existing fund operations. And to quickly give a introduction on YC Combinator, or YC, it's one of the world's largest startup accelerators, and it's been a year since YC transitioned into a new schedule of 4 batches per year, which allows for more frequent opportunities for founders to participate in YC and present their companies at demo days. So several big companies that you are all probably familiar with have participated in and graduated from past YC demo days. So this includes Stripe, Airbnb, Coinbase, DoorDash, and Instacart, just to name a few. So where exactly does AngelList come into the picture? So each quarter in parallel with YC Demo Days, we have the privilege of supporting 4 esteemed YC alumni who are each launching a fund that gives you the opportunity to invest in the fall 2025 batch of YC companies. So you can choose to allocate your commitment equally across all 4 funds, or you can choose to invest in specific funds. And the fund leads will leverage their YC connections and experience to deploy that capital to the batch's strongest companies. And the purpose of our webinar today is for you to meet and hear directly from our leads. They're all YC alumni, successful founders, and experienced investors. So Ben, JJ, Nate, and Philip, thank you so much for taking the time today. We're super excited to have you here and to learn more about each of your investing philosophies and overall thoughts. So to get started, I'd love to do a quick round of introductions so our leads can share a little bit more about themselves and their demo day investing philosophy. So Ben, we'll start with you, and then we can go alphabetical order by first name.
All right. Well, sounds good. Well, pleased to meet everyone. So I'm Benjamin. Been running demo day funds since 2017. I've backed over 500 Y Combinator company to date, and one of the most prolific investors within inside the program. Professionally, I do this full time, and I was an early Y Combinator participant back in the winter 2011, and behind the team of the Pebble smartwatch. Prior to joining the smartwatch world, I was a high frequency trader for 6 years at 2 hedge funds, and did a fair bit of early computer vision research back in the late 90s and 2000s. I have a degree of engineering from University of Michigan and a master's in finance from London Business School. And succinctly put, I really focus on building broad, diversified portfolios, really leveraging kind of the power law distribution, which is to say the kind of nature that your winners are driving a vastly disproportionate percentage of value kind of in the end portfolio than anything else. So it's really more about missing out on the winners, which is going to dictate your overall returns, and focus on casting a wide net, getting both kind of the middle of the road, very kind of, hot companies within any particular batch, but also very tactically, including a lot of the kind of the mid and long tail companies around here that may have yet to actually kind of discover what is the next breakout success. So that is that.
Awesome. JJ?
Hey, I'm JJ. This is my 8th demo day fund now. I've been doing it for 3 years. I started a company in the winter 15 batch called Way Up. We were the largest marketplace to help students and recent grads find jobs and companies hire early career. I ran that for 7 or 8 years, sold it in 2021. When I left, the company was around 150 employees. Right after that, I went back to YC and was a visiting partner there for a few batches. I worked with over 100 companies, doing the whole job, reading applications, doing the interviews, investing in them, working in them. I helped them raise over $200 million in seed funding collectively, any of the batches. these days, I both do investing full time, but I also run primarily a go-to-market program for post-seed startups. So I get to see startups not just during YC, but then afterwards, who actually does well and how do they do well, and dig deep into their businesses. Between my experience doing all these things, in particular having worked at YC, very well placed to know how to invest in YC companies. For me, it just has made a big difference to see how the sausage is made, and I think I'm a better investor for it years out from getting able to be on all sides of it. Now, and I've been investing for 7 years total, including my time as an angel while I was at my company, with early checks into Ramp, DBT, Retool, High Touch, Reducto, Gumloop, quite a few others. Well known within the YC ecosystem, regularly told I get great reviews from YC founders. Before all of that, in another life, I went to Penn undergrad. I was in a program for international studies and business. When worked at McKinsey, and then after that did a total pivot and taught myself to become a fully fledged software and DevOps engineer before starting my company. So I have the hands-on tech knowledge, the business knowledge, and I've seen companies grow from tiny to much bigger and advising them along the way.
Awesome. Nate?
Thanks, Sarah. Hi, my name is Nate Matherson, and this is my second AngelList Demo Day fund. But I've been investing in YC companies for about 6 years. I've invested in 140 YC companies, typically focusing most on SaaS, developer tools, fintech. Before becoming an investor, I was actually a founder for about 10 years. I did YC twice. I was a founder in the winter 16 batch and then the summer 21 batch. Typically, where I'm the most helpful with the companies I invest in is on all things growth and go to market. As in my full-time role, I'm the head of growth at a company called Numeral. So while I'm not an investor full-time, I'm in the weeds day to day trying to acquire more customers. And that's typically where I spend the most time with the companies I invest in. And yeah, in any given batch, I typically invest in about 12 companies per batch.
And Philip?
My name is Philip Winter. This is my 6th batch investing. Been investing for the past 8 years. Have done over 100 YC companies. And past investments include Anthropic and Perplexity. I went through YC in the summer of 2015, co-founded a company called Nebbia. We did it for 9 years, raised 4 rounds. Our first investor was Tim Cook. Eric Schmidt and Joe Gebbia were also investors in the company. At one point, we had more money than we needed. At one point, we ran out of money. We partnered with a leading public company in the industry, and then we rebuilt it for 4 years and sold it in 2022 to a company called Brondell. And for the past couple of years, I've been working mostly as an early stage deep tech investor. About 10 months ago, I was brought in to run another YC company that was in the summer 18 batch. In the biotech and food tech space, which we sold last month. Undergrad at Penn and grad degree at Cambridge. I invest alongside 2 founders, Brian Chen, who was in the winter 15 batch, a company called Blue Smart, and Mike Hinckley, who's a former growth investor and product lead at Airbnb. So between our range of backgrounds, we try to cover the areas that we know best, and we do between 20 to 25 companies. Try to be early and fast, but also, as was mentioned earlier, look for outliers at different stages, not exclusively the very hot companies.
Awesome. Well, thank you all for introducing yourselves. Now, would love to dive into some of the pre-submitted questions. And again, don't forget to use the Q&A button to submit any additional questions you might have that come up during the webinar. So let's get started with a theme that's close to home for all of you, the founder to investor journey. So JJ and Philip, let's kick it off with you both. How do you think your unique perspective as YC alumni has informed and shaped your experience as an investor in the program? We can have JJ start and then Philip.
Sure. I think I said this a little bit in my intro. So I think first, being an alumnus, there are a lot of people who invest in YC, but I think for the alumni, having gone through the program, you have such an immensely good understanding of what it means to be a YC company, what it takes to get in, how unpolished founders at the beginning or even at demo day can grow into some of the most incredible founders and incredible companies that you kind of can only learn by seeing it firsthand, by having gone through it. So I think that's in common across all of the alumni. And I don't think I don't know how I would do a good job investing without having had that experience. For me in particular, having done the job, I get to see, I understand a lot better than I would have before. How do companies get picked? Having done the admissions process, it's made me a lot better as well. We get a limited amount of time when we talk to companies, 30 minutes or so. And that's it. What you get is a small angel, but during YC, I had 10 minutes. So 30 minutes is a bit of a luxury these days. And all of that stuff helps me get to assess founders. And then even on the other side, sometimes I'll ask myself, why did this founder get accepted to YC? Because often it's surprisingly unclear. And between having done it myself, knowing a lot of the partners and knowing which partner accepted them to YC and having an understanding of their taste, it helps me get a bit more of a sense of, if this is a company that's a bit unusual, but is in this partner's sweet spot and they really like, and I should look at it, or is this maybe somebody just rounded up?
Philip?
To build on what JJ was saying, YC was really intense. It was the most peer pressure that I've ever felt. But that atmosphere was created in a way that also felt supportive. And going through that experience was a before and after moment for me. And I think it has remained that way consistently, even as it has swelled and gotten smaller and gone from 2 batches to 4 batches per year. And so there is just a very strong affinity for having gone through that experience and knowing what it takes. And that is something that I think we all rely on. With respect to, having gone through the program and how that informs me as an investor and what I look for, I think increasingly there are tactics to bluff or sort of fake your way to growth, especially in the early stages. And I try to really sniff out the companies that are doing the difficult, sort of dirty work of getting customers in a repetitive, but also in an informative way, rather than just relying on, friends and networks and sort of boosting in the early days, especially as the batch has gotten a little bit shorter and companies are under pressure to get to revenue even faster with AI. And we're seeing sort of record MRR and ARR figures even before demo day. I think the pressure to do that is even greater. But the founders who don't succumb to that and acquire customers in a sort of in an honest way that tells the truth about their product, that's what I really try to look for. And having gone through the program, all of us, I think we know the ways that it can be kind of hacked, and reading through that is very important, especially when we have few signals to work off of.
Great. Thanks, JJ and Philip. Ben and Nate, coming to you next. What do you think is the most overlooked value you bring to founders beyond capital? So, Ben, go first.
Well, I wouldn't discount capital. We spent a lot of time kind of downstream, helping connect companies that are, moving onwards to additional capital. And, be that through SVPs or making kind of introductions stuff. So, I think it's a bit of a tendency to say, hey, there is, the capital isn't actually visually important to doing this. But, when it gets down to it, the venture business is really, about 3 things. It's providing connections to capital, it's providing operational advice, and it is providing connections. And so, much of, the other aspect of works beyond capital provision is, I think, certain tactical devices, everyone has their, particular focus where they have, an area of experience in. But then, a lot of the area where we spend time on and actually build systems around are, how do we facilitate connections? So, we have platforms in place to help identify, what connections our LPs have. I mean, we're now at, 1,000 plus LPs. So, it's collectively our second order network's about 2.5 million people within inside there. And if you think about it, a introduction to, say, a partner at a law firm that you may have worked with, can very quickly lead to a contract for a company that, say, is providing, AI security tools for law firms, or legal introductions. And in the early stage, that has a real, I want to say, important and visceral impact on the growth trajectory, the ability for that company to quickly grow, get market share, and then move on to the kind of the next stages and the next stages of the venture pathway. So that I think is probably the single most valuable area, also along lines of, hiring employees, so forth, and then, connections for, I want to say downstream capital as well.
And Nate?
Yeah, I think Ben makes a really good point there regarding downstream capital. And I think this happens after we invest immediately. I think the group here prides ourselves on being some of the first checks into these companies as they're going through Y Combinator. And I think we do really see it as a duty to make follow-on intros for those companies to help them build momentum in their rounds kind of going into demo day and closing those rounds before demo day. But then even this week, I think I've spent like 2 hours making Series A introductions for companies in the portfolio. And so I do really see it as my job to help these companies not just raise their seed round in that immediate band of time, but also then raise the Series A and Series B or whatever it might be. But me specifically as an investor, I usually provide the most value, like I said, on all things growth, marketing, go to market. That's what I spend most of every day thinking about. And depending on the founder or the business, they might be at a different stage in that journey. Like if it's a very technical dev tools company and these two founders are brilliant, but they've never sold or marketed something before, like it's one type of a conversation. But then other times there are businesses that maybe have more experience in growth and go to market just as founders themselves. And often it's a very in the weeds conversation. For example, like how do we like A/B test subject lines on our LinkedIn message ads? So depending on the founder, the stage, the type of the business, the conversation I'm having about growth and go to market is usually quite different. But it's something I really enjoy. And I think my reviews in like the YC investor database typically speak to that.
Awesome. Well, I'd love to talk a little bit more about the inner workings of YC and how that experience translates into investing. So, JJ and Ben, from your vantage point inside YC, how do you identify breakout potential both in the company and in the founder before metrics or traction signal hit to the broader market? And we can start with JJ.
There are a few things. One area, like I was saying before, even just the fact I got 30 minutes to talk with the founder instead of 10 makes a huge difference. There's a lot you can tell about a founder's grittiness, seriousness, and judgment in that short of time by how well they know their space, their numbers, how deeply they've thought about how well they'll grow. Even if they end up pivoting, very often you're evaluating a founder based on, even if you hate the idea, based on the depth, sort of what I would call like the feralness, like how gritty and unwilling to give up are they, combining that with not just how smart they are, but how much work have they done on what they are doing. And often you'll have great founders who are in a bad space who you want to know that they're going to realize eventually that maybe they'll figure it out, but probably they'll realize it's a bad space, pivot to somewhere else, and end up growing to something huge. And I have quite a few companies in my portfolio where the founders took that shape. Another thing that I look into right from the beginning is co-founder dynamics. How long have they known each other? How did they meet? Are there weird power dynamics? Sometimes that can happen if it's like a tough space like hardware and one is an expert in domain expertise. I'm not afraid to dig into that live. And then in addition to all of that, I do a lot of back channel and homework on every single company before I meet them, which is a lot of work when we're talking 200 plus companies. But every single one, find out who they are, what they've done before, if I can get background references, and you just come in really, really prepared to make the most of your 30 minutes.
Yeah, I'm now second what JJ says about preparation. You have 30 minutes to talk to, which is a very sufficient amount of time to work through. I mean, about 10, 15 minutes, you can kind of get to the point of making a decision. But the vast, vast majority of work in deployment happens before you get on the calls. So, the deep research, we have a certain, being alumni, a certain degree of connections and so forth within inside the ecosystem, which gives us an advantage on the information that we're able to pull in, and then really kind of, building out and tactically identifying who you're going to reach out after. I would say quite uniformly, like, within the YC ecosystem, most founders are exceptional. Most companies are, either they're have figured it out or they're, in the process of figuring out what's going to be the current stage of growth. And every company is going to go through a variety of things. And then you have a section of companies that haven't figured out that are just going to, it will take a while, but the model you want to think about on a startup is, it is not an architected plan. Companies are, they're a search activity where they're, progressively going through various stages of finding scalable business models, then capturing that, and then eventually you plateau and you have to find kind of the next area of growth. So it really is an area where forecasting, I'd say, is a bit of a fool's errand going in here. And so, a lot of the way that, I think about what it is that we do is much more about kind of, portfolio optimization, making sure that we spread our bets around in a particular sort of way so that we increase the likelihood of getting a few of those outliers. And I mean, look back to my portfolio. It's like, we have had some of the, top best performing everything shining companies going through, but then we've also had founders that, still marked at cost on our books, but they have built highly, highly profitable, repeatable businesses just out of their, true grit. And it's, very hard from, day one to know which ones there's going to be. So, my view is, less about the importance of that at this particular thing and making sure that you get, adequate diversification across it. And, we've constructed a model where we can do that. We can go on the companies that are high conviction and so forth, but at the same time, very tactically, identify founders where it probably isn't clear today. I mean, it certainly isn't clear today, whether this is going to be, valuable or not in terms of a business, but they're working in a direction that's very interesting, a direction that, often no one else is going in. And that will ultimately, transpire to them figuring something out that is new and novel. And then they ultimately end up in a market where they don't have the same level of competition as everyone that's kind of running after the, median of the bell curve side of things. So, I think there really is value in both sides of kind of the approach to your portfolio construction.
Awesome. Thanks both. And for our next question, how has YC's evolution from smaller cohorts to hundreds of startups per batch changed how you allocate time and conviction across opportunities? And we can have Nate and Philip jump in for this question.
Yeah, YC has changed a lot over the last, 5, 6 years as an investor for me, but certainly over the last like 10 years since I was first a founder in the Winter 16 batch. The batch sizes are bigger. I typically talk to about 60 companies per batch. And so I'm not talking to every company in the batch, but I'm talking to a decent number of companies. It takes an incredible amount of time. And it's usually fairly concentrated. And so I think one of the huge advantages that we have here as a group is because we're a YC alumni, because we have good ratings in the investor database, we can get those conversations earlier. So like we're typically having our conversations a few weeks before demo day. And usually that means for me talking to about like 60 companies over the course of about 5 days. I think there was a weekend, the last batch, where I talked to like 28 companies on a weekend. And so, it's a lot of work to talk to 60 companies in a batch. I respect the people who do talk to all of them. As far as like building conviction, I mentioned earlier, I do about 12 companies per batch. Like for me, that's actually a little bit like broader than I used to do when the batches were slightly smaller. And so I do take more shots on goal, but the fund is still relatively concentrated. I would say like in any given batch, like, there's a few deals that like you just know are like ones that everyone is paying attention to. And then, but for the vast majority of deals, like you do need to plan upfront. You do need to kind of have a game plan going into the call so that you're prepared, so that you can use that 30 minutes effectively. But then I make quick decisions, like typically making the decision on the call or the day after the call. That's kind of my process.
Philip?
YC started in the summer of 2005, and it was 8 companies. It took a while to grow. By the time that I went through it in the summer of 2015, so 10 years on, it was just over 100 companies. And it got to between 300 and 400 companies in sort of the post-COVID era. And I think that a very important course correction and have gotten it back down to more or less 150 companies. It's not a strict number, but it basically averages out to that in the last several batches, which I think is a sweet spot. Talking to founders who are repeat founders, and it'd be interesting to hear Nate speak to this as well. It's remarkable the consistency between them who say that it just keeps getting better. And the NPS was already extremely high when a lot of, all of us went through it a decade ago. um, so that's sort of just a little bit of context in terms of how YC has gotten to where it is and how they've tweaked their model. Of course, they now do 4 batches at 150 companies. But important to note, the partners now are on cycle and off cycle, so they skip a batch, and so they still do just 2 batches per year for the most part. I work with, as I mentioned, I work with 2 other investors, and we make our own categorization of the batch, and then try to develop some degree of sort of more specialized expertise, increased pattern matching. We can compare more acutely with past batches because we've pretty much looked at all of the companies in that category, subcategory. That's been really helpful. Occasionally, we do mix it up and change who's assigned to what. Sometimes the categories morph, new ones show up. And to build on what Nate was saying, in terms of how we make decisions, I think this is probably the case for Ben and JJ as well. We have a pretty strong sense before we get on the call, and that is either confirmed, usually within the first 10 minutes of the call, or not. And increasingly need to make the decision same day, if not by the beginning of the next day, because the deals are moving ever faster.
Great. And for our next question, how do you think about portfolio construction or concentration within the YC pipeline, balancing breadth of exposure with meaningful ownership in potential breakout companies? So Ben, why don't you start, and then we can have Philip jump in again.
All right. Well, I am a large proponent of breadth. A lot of what we've done started with, kind of whole viewpoint started with quantitative modeling of the systems. And, if you look at, both venture as a whole, but within YC companies, the returns are heavily, heavily skewed. So, I mean, you have the exceptional ones, such as the Airbases and Airbnbs and the Coinbases of the areas, and then it kind of works its way down. And in every segment, there's always kind of a very small percentage of outliers. And when you look at YC, historically as a whole, they've published that it's 6.5%. I think of those hit unicorns, and then 25% of those go on to kind of the decacorns. So 10 billion plus. In terms of it. And so, if you have those type of companies that are driving such exceptional returns from a seed investment around here, you really want to maximize that. And that will end up kind of, shifting your risk reward, profile, your expected return, higher, as well as giving you a higher likelihood of hitting that mean or median, in terms of what your, outcomes should be. And so, really, my view has always been that, our goal is to give you the best risk-adjusted returns on what is already an exceptionally high quality, I want to say, product, so to speak. We've done studies back in our previous ones. Back in 2023, we looked back at our W21 portfolio, our S17 portfolio, and in that, with inside the ecosystem, because of that, we had hit the highest number of companies. Our proxy was it had hit 150 million valuation or more. We had, I think, 17, the second, third, and the fourth, or fifth most valuable companies on there. The interesting thing is we'd missed the most valuable company on there, and if you looked at that, we would have had a fund that was 3x larger than it would have been in terms of valuation. So, that gives you a sense of how important it is, capturing that. I mean, we still, historically along those portfolios are, up or around the 90th percentile of venture funds. So, YC does very well. In fact, all investors that typically regularly invest in YC really do beat the wider market for venture. So, don't understand how I think about it. I am broad portfolio construction and, delivering something that's going to extend the kind of envelope of your risk reward curve. So.
And Philip?
I feel it's appropriate to follow Ben. Most of what I've learned about this, I've learned from Ben. I don't say that just to toot his horn, but he really is probably the most sophisticated person thinking about this and has been doing it for a long time. Our approach is perhaps a little bit different and built around sort of the process that works for us. As I mentioned, 20 to 25 companies, big enough to get exposure, but still focused enough to sort of enjoy returns when we hit a winner. YC investing, like all early stage startup investing, is power law driven. And as Gary Tan has encouraged everybody investing in YC to do, and he said this publicly, the principal job is to identify the companies or the founders that are least likely to be successful and sort them out and then pick amongst the rest of the group. These are figures that Gary Tan shared. The of funds that build a portfolio of YC specific companies, the top 25% of those achieve a TVPI of 8x compared to 1.6x for the rest of venture. And the kicker here, the median 50% still achieve a TVPI of 5x compared to 1.2x for the rest of venture. And that's Carta and Orange Collective data. I think that says it all. We are picking amongst the best crop of founders and companies in the world, bar none, consistently for the past 20 years. And it's a privilege to do that. And our job is to select who we think are the best amongst those. I think by investing in several of these demo day funds, you will get exposure to lots of different portfolio constructions, and that's probably the best way to go about it.
Awesome. And now that we're a year into the quarterly batch structure, how have you seen the YC environment and deployment process change since this transition? And maybe we can have JJ and then Nate jump in for this.
Sure. There are a few things, both good and bad. I'd say the first thing that I had a lot of LPs ask me, am I worried about quality getting worse? Quality has not gotten worse. Companies are still great, growing faster than ever. Founders are still incredible. I think there are more companies and more founders doing YC than ever. And a big part of that was the goal of the 4 batches, which is if you're a founder and you're starting a company and the timing doesn't align, you don't want to wait 4 months for YC. Now you don't have to. So we actually get access to even more amazing companies that wouldn't have done YC in the past that do it today, which is really cool. This is also not related to the 4 batches, but seeing much more of a return to not just AI and software, but all types of unusual hardware and other types of hard tech, which is really exciting. I think one thing with 4 batches that's been different is the batch is a bit shorter. That has made companies be less fully baked, I would call it, where no founder coming out of YC is perfect. It's still always very early, but there is something about those last 3 weeks, I think, from the old style, that if founders had to pivot mid-batch, you'd have more traction. That has made it, I think everyone on this call is really well equipped to assess founders, but I think even for all of us, it's made it a bit more challenging. It maybe gives us a competitive advantage as YC insiders to be able to tell who is good despite the less time, but you're working with everything being a bit less fully baked. And I'd say the last thing that is probably unrelated to the 4 batches, but has been a big change. YC has always been a competitive environment, and there's been a lot of capital approaching it for all companies for a long time. But over the past year, this has increased to a dramatic degree, where, as Phil or I think Ben was saying, you really have to commit same day, or I pretty much commit on the call now. Again, we're very well situated, all of us having good reputations, know how YC works, being alumni with good book face reviews and good preparation to come in and do that. But I could imagine it being a very, very hard time doing this job if you didn't have the experience that we have.
That was an amazing answer, JJ. I would love to add many things, but I thought your answer was so thoughtful and really, really great. I would agree with you that the quality of batches has not gone down. I would actually say that the summer 25 batch was the best batch ever, or at least like it feels that way. Like I feel like it was the best batch that I've ever been a part of as an investor in the last 6 years. So in terms of quality, I think the quality is as good as it's ever been. And I think just to echo JJ's point one more time, the quarterly batch structure is really a great thing for founders because it aligns better to their schedule of building a company. And I also think it's a great thing for investors. And then to echo Phil's point from earlier, in an annual basis, maybe the same number of YC companies is the same, but like on a per batch basis, the batches have actually gotten quite a bit smaller. Like when I was in the summer 21 batch, there were over 400 companies in that batch. And then to Philip's point, now there are about like 150, 170. So yeah, I think it's a good thing for founders. It aligns to their schedules. They actually get more attention. The batches are smaller. And then finally, to just echo what JJ said again, I would actually say that the last batch was the fastest moving that I've ever seen in terms of like lead investors participating, big check writers participating, deals moving quickly. And yeah, yeah.
Awesome. Well, would love to talk more about signals and conviction. So, our next question is, how has your approach to conviction building changed as data and AI tools increasingly inform sourcing and diligence? So, Philip, do you want to start us off for this one?
Sure. I would say it's just made it like all things, all work streams where AI is impacting, it's allowed us to spend more time on the high level things. And so we have sort of invested and built our own tooling. It helps us do the upfront work that was mentioned in a more robust and less sort of labor intensive way. From identifying when the company is launched to allowing us to be sooner, sort of first emails in their inbox, the company research that we do. But ultimately, like nothing can replace those first 10 minutes on a phone call. And then if worthy, sort of the next 20 minutes of a phone call, which rarely change perspective, but sometimes it does. And I really like asking founders questions that sort of throw them for a surprise. One of the things that YC um, instilled in me was a resiliency to being cut off. It's almost like they did it for sport. Um, I can remember the partners just very aggressively cutting me off after they'd asked me a question, and I was like midway through the second sentence, and I realized that um, it was partially the culture of YC, which is sort of ruthless about clarity and conciseness, and I think that comes from PG and its origins. But I came to believe it was also like a test and a mechanism to see how quick I was able to pivot and sort of task switch in live. And so I do that sometimes, that sort of thing. I try not to be an asshole about it, but I do that, and it's really interesting to see who takes it in stride. If they hadn't finished a point, how do they come back to it? But I'm also trying to understand why is this person in the top 5%? If they don't have some extreme breakout traction, which okay, then it's very clear sort of where to focus on. There is some, signs of product market fit. In the absence of that, which most companies don't have that, um, why is this person in the top, 5% or the top 2% of people in the world to be building this product at this moment in this way for this particular market? And that's really what I'm trying to get at. And that can't be replaced, or we haven't found a way yet to replace that other than live on a call.
The question was around using data and AI tools to kind of supplement the sourcing and diligence process, right, Sarah?
Yeah.
Yeah, I think it's made doing research before a call a lot easier. You can get smarter a lot faster and ask better questions as an investor. I've tried to like play around with like different orchestration of data. Like for example, looking at like which companies in the YC batch are getting the most website traffic, or like which companies, back in the day I built this like model. Back in the day, as in like a year ago, I had this whole matrix of like website traffic versus like GitHub star growth. And like, I don't know. I actually don't think it was that helpful. I don't think I think these tools are helpful to go a little bit deeper, but like you certainly can't rely on them to make decisions. I think in any given fund, like half of my investments, like I typically make up my mind in about like 5 minutes. And I say that because like I've come prepared, but also the founder checks the boxes. Like in most calls, like you don't have 100 questions. Like in most calls, you have like 4 really important questions. And like you can often ask those questions in about 5 or 10 minutes and get your answer. For the other half, yeah, maybe it's a full 30-minute conversation of questions. But I think these tools are helpful as data points, but like you certainly can't just invest off of a spreadsheet that relies on website traffic and GitHub stars. I think that would be a disaster.
Awesome. All right. And Ben and JJ, this next question is for you. But in a world where capital is abundant again, what do you think differentiates truly high signal investors from everyone else?
Shall I
Yeah,
kick it off?
yeah,
All
sure.
right. I think when it comes down to it, being a successful investor, particularly within the YC, is about reputation. You need the reputation to get the companies. You need to get the reputation once you're in the companies that people are going to, listen to you. So that, plays out in terms of network. It gives you access to information. It gives you, connections that can leverage in a tight deal where, JJ is in the company. He can help us get into a company, vice versa, and then our broader kind of, YC side around network around that. And, the important thing to understand about YC investing, it is not about kind of picking and kind of stack ranking between companies. Like, it's clear you can figure out what ones are the good ones. You can move the old ones there. It is your ability to get allocation within inside the company, and every single thing that we do, that everyone in this group does, partially by provenance from being, alumni in the program, is structured around ensuring that we're the first people on those calls. We're able to get the capital allocation. As a result, over time, we've got that signaling ability that's come out of it because we are in the deals that everyone wants into it. We are in early, sometimes even at preferable valuations to, kind of the later stage in the YC thing by demo day or so forth. And, over time, then our ability to kind of push that information, out. So, demo day is a really interesting kind of investment period. It is, not to trivialize it by calling it a sport, but like, it is a 3-week period where you have to be on 100%. You're going to bed at 2 a.m., waking up at 5, doing stuff back and forth to, work within our network, the wider network, and so forth to be able to, get in the hot companies, but also take the companies that you are in and make sure everyone else knows that these are the companies they want to, prioritize and stuff to make it a very quick and easy process going through. And then downstream all of the work to support. And what really goes down to is, do you care more than the next person about making your companies successful? And I think there are, a segment of the venture population that, that is who they are. That is what they get. That is just the nature of being, a YC alumni. But then you very quickly, as you move kind of outside that kind of sphere of people, if people want to throw around money, they want to kind of feel like they're in control. And that's just not the case in YC. You have the upper, fraction of 1% of companies within inside the, globe here that are, they're on offer, and they get to choose who they work with. And if you are that type of person, you're going to be in it and you're going to get YC success. If not, like, you have to deal with the second and third order businesses out there.
I think everything Ben said is very, very right. I'll try to give my answer. I might overlap a bit. I think that when I think about investing and how to be good, And so the question is a little, what does it mean to be a high good investor? Is that good for the founders? Am I going to pick well? Are we going to have good returns? For me, being a good investor, I think there are four things to know. Are you going to actually get into good deals, which is kind of what does it matter? You need to have a seat at the table. You need to pick well. You need to then actually get in to best point allocation. And then sort of the long tail one, but I think one of the things that we differentiate the most actually be helpful to companies. Having a seat at the table, everyone on this call does through our connections with YC, and the amount of pre-work we do to make sure that we are well prepared, emailing at the right times. Picking well happens both before and after with hundreds of companies. We're talking to a lot of them, but I don't think any of us is talking to actually 250. So you have to pick well even up front. You have to do a lot of work and collaborate like we do to know who's good if we can't talk to everybody in advance. And then, obviously pick well after you talk to them. Getting in is where even getting the first meeting is challenging. And this is all, I should be clear, this is all within the YC landscape. A lot of this is in common with investing in the broader world, but YC is so its own unique way of investing. Depends what how demo day. Demo day, it's not even a marathon. It's like a 3-week sprint. You got to go really, really fast and can never stop, and also need to have been training for a while to get there. So all of this like is just sort of a different mentality than investing outside of YC. So even if you pick well, getting in, like allocation moves so fast, you might commit on the call, but the fact you had your call an hour later than somebody else can make a big difference in the allocation of the price you get. That's everybody's laughing because like it's happened last batch. It's true. So you have to get your call early. You have to be able to get in. And well, how do you get all of that? Well, it's not just experience, but it's having an incredible reputation, to Ben's point, and that comes from being helpful to founders, being available when they text you, doing no harm, which is a shockingly low but real bar for most investors, having good network, helping companies fundraise their Series A, like a lot of people on this call have said, doing all of that with authenticity, and having a reputation, not just from Bookface, but from founders talking to each other, is what will make founders take your call earlier and then let you in and give you, not just let you in, but give you the allocation you want and not cram you down. And all of that matters the most. It's both made this job harder, but also more rewarding, because whenever a founder says to me or to any of us, like, yeah, I'd love to have you in my round and I'd love to give you what you asked for, it's not just a cool money. It's they're really picking us over. They could say they have more money than they could possibly need, and they're choosing us.
Awesome. And would love to take a closer look at market and YC ecosystem. So for our next question, which markets do you think are being underestimated because they don't fit neatly into current venture narratives? And Philip, do you want to start us off for this one?
Sure. I'll try to be a bit more brief, just appreciating how much time we have left. I think it's sort of the traditional ones that are left by the side, but for whom AI is a real game changer. So sort of the boring industries where automation is making a particular impact already and very quickly. For example, in the last batch, we invested in a dental platform automation business. It's a multi-billion-dollar industry. It has yet to be consolidated, unlike other similar practices. And so it sort of missed out on the SaaS era of consolidation. Construction and trade, I think there's a huge opportunity to improve a very compressed margin structure in those industries. Things like facilities and building management, logistics and transport, healthcare, specifically elder care, and maybe also, previously untouchable or very difficult, easily avoided businesses that were focused on selling to small and medium customers, or SMB B2B customers, where CAC was really high and it was a sort of a revolving door, high churn. I think that those are the ones that come to mind.
Yeah, I mean, I think, if we talk about underestimated, I mean, I think, just the ebbs and flows of the venture market, because you are, trying to forecast, 8 years out in the future, it tends to people a lot of the time, just as a collective, look to other people for signaling. And that dynamic tends to, just almost on a purely random basis or so forth, get, capital and interest to coalesce around, a small select number of companies, a small select number of industries and so forth. And, really discount the, value and viability on the stuff. And, I mean, very much as Philip mentioned, there is the front of the office sexy stuff that's out there, the AI doing, some fancy robotic things that everyone just is like, this time is great. We love it. But, you have predominantly what I'd call the back office. So, the supply chain, the compliance departments, the other stuff that is, incredibly paper heavy, people heavy and so forth. Processing insurance. Just think about the amount of work and people and money and costs that go into that aspect of it, as opposed to the sales of the insurance and so forth. And so you really have this very kind of, clean split. It's like, I always, when I talk to a company, those that are going to be in the back office are going to have a harder time selling. But at the same time, those are the companies that, one, are going to have a little better valuation, two, are going to have less competition, two, are going to be able to deliver a product that really delivers high value to their specific, companies. So, you know, that is the type of thing that I always feel is a little, underestimated and undervalued, but I am not going to complain because we get to play in that space, and, a chunk of our portfolio in that space does exceptionally well as a result.
Yeah. Well, it's been a really amazing conversation and super appreciate the insights so far. So just to be mindful of time, we'll kind of wrap up with a quick lightning round of Q&A. So if you didn't submit a question, or you did submit a question that we couldn't get to, please send it to demoday@angelist.com and our team will follow up with you directly. But just to kick us off, first question, what is the biggest misconception people might have outside of the YC ecosystem have about investing in YC companies? So we can kind of do a lightning round here. JJ, or anyone, if you want to jump in.
I can start. Oh man, it's hard to pick one. I'm going to give like a couple, and I'll be short. So one, I think the biggest one is that buzz matters at all. It is, having been like on the inside and all of us being part of seeing rounds come together, which companies happen to get hot and then everybody talks about is wildly uncorrelated with who actually does well. And it takes a lot of discipline to just not let that get to you. The second thing I would say is that prices are crazy or reflective of the quality of the company. A lot of the prices are much higher compared to the rest of the market, but this is the best crop of early stage companies you're going to find anywhere in the world. You get what you pay for. But then also, again, the price of companies is often related more to the hotness of the round than how good the company is. And within the context of YC, there are great deals to be found, but even if it's not a great deal, it's still worth it anyway when they exit at $10 million.
I'm happy to go next. That it's just about the reputation or the brand, like categorically no. These founders go through an incredibly intense experience and it changes them. And that's why the NPS and the affinity and the loyalty to the alumni group is so high.
Biggest misconception about investing in YC companies. I'll often hear like, it's like buffet, right? I can just choose any company I want and invest in it in the batch. And like, that is certainly not the case. Like there was a company in the last batch that I legitimately like cold called like 5 times to like get the founders on the phone, and then ended up investing in. It is a chase. There's always like 5 to 10 deals that have an incredible amount of heat on them. And if you want to talk to those founders, that's one thing. If you want to get a check in, that's another. If you want to get in a full size check or the amount of money you want to invest, that's a whole nother thing. And so it's a game of getting the allocation you want in these companies. And to JJ's point, the prices do change. So getting in at the best price at the right time versus a price that's much higher later on.
Yeah, and I think, I mean, I'm just going to echo what Nate has says. The preconception for investors when you're dealing with the wider market is you're the individual that holds the, or is the individual in power. You hold the check, you get to make the decisions. That applies to 99% of the market. But when you're dealing with the upper 1% of the market, the situation changes. Companies have a fixed amount of allocation that they're going to put in there. And the best companies are not looking for the capital per se. They're looking to build the best team out there. And so the power dynamic, completely shifts. And so, when you are looking to be successful within the YC investing ecosystem, it is purely predicated on your ability to get that allocation around there. And, that is where the YC alumni advantage comes, because you are one of these individuals, and that allows us to get on the calls, get the capital invested, and then help support and make the companies kind of better in a way that truly is going to drive value downstream.
Awesome. Well, looks like we've covered all the questions we could get to today. So thank you again, Ben, JJ, Philip, and Nate, for sharing your backgrounds and more insights into your investing approach. And you can find additional information about each of these offerings on the fund pages, documents, and on our Demo Day website, which we'll drop in the chat. So as a reminder, the minimum to invest per fund is $5,000 with an expected closing date of November 25th for all funds. And investments will be accepted until the close date or until the funds reach capacity. So again, a huge thank you to everyone who tuned in today. And if you submitted a question we couldn't get to, please send it to demoday@angellist.com and our team will follow up with you directly. Thank you again, everyone, and have a great rest of your day.